So you want to own an apartment building. Maybe you've watched real estate investors on YouTube talking about passive income. Every month, dozens or even hundreds of tenants pay rent directly into your bank account. Your property quietly appreciates in value while someone else pays down your mortgage. Over time, you build equity without lifting a finger. It sounds like the perfect investment. Buy a building, collect rent, hire a property manager. Watch your wealth grow. After all, people will always need somewhere to live. From the outside, owning an apartment building looks like the ultimate passive income machine. But that's the dream. The reality is that an apartment building isn't simply a collection of rental units. It's a highly leveraged financial asset, a property management company, a maintenance business, a customer service operation, a legal enterprise, and a risk management system, all operating 24 hours a day. You're not simply collecting rent. You're managing hundreds of moving parts. Roofs leak, boilers fail, elevators break down, water pipes burst, tenants move out. Vacancies increase. Insurance premiums rise, property taxes change, interest rates fluctuate. One unexpected repair can eliminate months of rental profit. And unlike stocks, real estate cannot be sold with the click of a button. Before your first tenant signs a lease, you'll already invest millions of dollars into land, construction or acquisition, financing, inspections, legal fees, insurance, renovations, and working capital. Owning an apartment building isn't about collecting rent. It's about managing one of the world's oldest cash flow businesses. And the investors who become wealthy aren't always the ones who own the biggest buildings. They're the ones who understand the economics behind every door. Not all apartment buildings follow the same business model. Small multifamily properties usually contain between 2 and 20 units and are often managed directly by the owner. Mid-sized apartment communities typically contain 50 to 200 units with professional property management teams handling leasing, maintenance, and tenant services. Large apartment complexes resemble small neighborhoods. They include fitness centers, swimming pools, parking spaces, playgrounds, parking structures, security systems, and full-time maintenance staff. Luxury apartment buildings compete through premium amenities, concierge services, rooftop lounges, smart home technology, and high-end finishes. Affordable housing developments often operate with government incentives, tax credits, or subsidized rent programs. Student housing, senior living communities, and workforce housing each serve different markets with unique operating economics. Although every apartment building rents living space, their financial models differ dramatically depending on tenant demographics, location, financing, occupancy, and operating costs. The product isn't simply an apartment. It's stable housing backed by predictable monthly cash flow. Location determines almost everything. A building in a growing city with strong employment, population growth, and limited housing supply can appreciate dramatically over time. The same building in a declining market may struggle with vacancies for years. Investors evaluate neighborhoods using employment growth, school quality, crime rates, transportation access, nearby retail, future development, and rental demand. A 100-unit apartment building can cost anywhere from $10 million to well over $100 million, depending on the city, construction quality, and local market. Closing costs include legal fees, environmental inspections, engineering reports, lender fees, title insurance, and appraisal expenses. Most investors finance acquisitions using commercial mortgages. Lenders carefully analyze occupancy rates, debt service coverage ratios, historical operating income, and borrower experience before approving financing. Unlike residential mortgages, commercial loans often require substantial down payments and periodic refinancing. By the time the first tenant pays rent, millions of dollars have already been committed, and not a single dollar of profit has been earned. Buying the apartment building is only the beginning. Keeping it operating is where the real economics begin. Unlike a stock portfolio that sits quietly in a brokerage account, an apartment building is a physical asset that slowly wears out every single day. Every tenant who opens a door, runs a shower, uses an elevator, turns on the air conditioning, or parks a vehicle adds a tiny amount of wear to the property. Eventually, every component must be repaired or replaced. This is where asterisk capital expenditures, better known as CAPEX, asterisk become one of the owner's biggest financial responsibilities. The roof may last 20 to 30 years. Elevators often require major modernization after 20 years. Boilers, HVAC systems, plumbing infrastructure, electrical panels, fire suppression equipment, parking lots, windows, balconies, and exterior paint all have finite lifespans. Replacing these systems isn't cheap. A new roof for a mid-sized apartment building can cost $500,000 to more than $2 million. Replacing elevators often costs $150,000 to $500,000 per elevator. A complete HVAC replacement can easily exceed $1 million depending on building size. Parking lot resurfacing may cost hundreds of thousands of dollars. Even something as simple as replacing hallway carpet throughout the property can become a six-figure expense. Many first-time investors underestimate CapEx because these expenses don't occur every month. Instead, they arrive unexpectedly and often all at once. Professional investors therefore maintain reserve funds specifically for future capital improvements. Modern apartment buildings also require expensive technology. Electronic access systems, security cameras, internet infrastructure, package lockers, smart thermostats, water monitoring systems, property management software, leasing platforms, digital payment systems. These upgrades improve tenant satisfaction but require continuous investment. The building itself may appreciate over time, but everything inside it slowly depreciates. Understanding that balance is one of the defining characteristics of successful real estate investing. Once the building is occupied, operating expenses begin immediately. This is the world of operating expenses, OPEX. Property management usually becomes the largest recurring expense. Managers, assistant managers, leasing agents, maintenance technicians, landscapers, cleaning staff, security personnel, administrative employees. Larger apartment communities often employ dozens of full-time workers. Utilities remain substantial. Electricity for common areas, exterior lighting, hallways, parking garages, pools, fitness centers, water pumps, elevators. Heating and cooling shared spaces. Some buildings also include water, trash collection, internet, or gas as part of the rent. Maintenance never stops. Broken appliances, leaking faucets, painting vacant units, replacing flooring. Repairing drywall, cleaning carpets, fixing parking gates, maintaining landscaping, servicing elevators, everything requires constant attention. Insurance premiums continue rising, property insurance, general liability, flood coverage. Earthquake insurance where required. Cybersecurity for digital tenant systems, workers' compensation, all become part of annual operating budgets. Property taxes represent another major expense. Unlike fixed-rate mortgages, tax assessments often increase as property values rise. Ironically, appreciating real estate may generate higher tax bills long before it produces additional rental income. Vacancies create hidden costs. Every empty apartment loses rent every single day. Meanwhile, utilities continue, marketing continues, maintenance continues, mortgage payments continue. Professional investors closely monitor occupancy rates because every percentage point matters. A building operating at 98% occupancy can generate dramatically higher cash flow than one operating at 90%, even though the difference appears relatively small. Perhaps the biggest hidden expense is tenant turnover. When one resident moves out, the apartment often requires cleaning, repairs, repainting, marketing, leasing commissions, and administrative processing before generating rent again. Amenity memberships, internet packages. Some luxury buildings generate significant revenue through rooftop event spaces, parking memberships, retail leasing, or commercial storefronts on the ground floor. The most important financial metric in apartment investing is net operating income, or NOI. NOI equals total property income minus operating expenses, before mortgage payments and taxes. This single number largely determines a property's market value. Investors also monitor cap rate, cash-on-cash return, debt service coverage ratio, and return on investment, ROI, when evaluating acquisitions. A professionally managed 100-unit apartment building may generate $2 million to $5 million in annual rental revenue, depending on location and market rents. After operating expenses, the property may produce a healthy NOI, which supports financing, investor returns, and future appreciation. But the greatest advantage isn't necessarily today's rental income. It's long-term wealth creation. As rents increase over time, mortgage balances decline, and property values appreciate. Owners build equity while tenants effectively help repay the underlying debt. That combination of recurring cash flow, appreciation, leverage, and tax advantages explains why apartment buildings remain one of the world's most sought-after investment assets. Yet the smartest investors understand one important truth. Owning apartments isn't about collecting rent. It's about managing risk better than everyone else. No investment is completely safe. And despite its reputation as one of the world's most reliable wealth-building assets, apartment ownership carries significant risks. The first and most obvious is vacancy. An apartment only generates income when someone is living inside it. Every empty unit represents lost revenue that can never be recovered. Unlike a retail product that can sit on a shelf until someone buys it, an empty apartment loses income every single day. Occupancy, therefore, becomes one of the most important performance indicators in the business. Economic downturns create another challenge. During recessions, unemployment rises, household incomes decline. Some tenants fall behind on rent. Others move into smaller homes, find roommates, or relocate to more affordable markets. At the same time, landlords continue paying mortgages, insurance, taxes, utilities, and maintenance regardless of whether rent is collected. Interest rates can dramatically change the economics of ownership. Many commercial apartment loans eventually require refinancing. If rates rise significantly before that refinance, debt payments can increase by hundreds of thousands or even millions of dollars annually. A property that once generated strong positive cash flow can suddenly become financially stressed without losing a single tenant. Government regulation is another major risk. Rent control laws, eviction restrictions, building safety regulations, environmental requirements, accessibility standards, energy efficiency mandates. Each new regulation increases compliance costs while sometimes limiting an owner's ability to raise rents. Unexpected repairs create additional uncertainty. A burst water main, foundation issues, fire damage, roof failure, elevator modernization, major plumbing replacements. These expenses often arrive with little warning and require immediate action. Natural disasters present another threat. Floods, hurricanes, earthquakes, wildfires, severe storms. Even with insurance, rebuilding can take months while rental income declines. Then comes competition. New apartment developments may enter the market offering modern amenities, luxury finishes, and promotional pricing that pressures older properties to renovate or reduce rents. To remain competitive, owners frequently reinvest substantial amounts into renovations. New kitchens, updated bathrooms, fitness centers, smart home technology, package lockers, outdoor gathering spaces, dog parks. Parking lounges. Apartment ownership isn't passive. It requires continuous reinvestment simply to preserve value. The greatest risk, however, isn't the building. It's poor financial management. History has repeatedly shown that highly leveraged investors often struggle when market conditions change unexpectedly. Real estate rewards patience, but it punishes overconfidence. Despite these risks, apartment buildings remain one of the favored investments of billionaires, pension funds, insurance companies, and private equity firms. Why? Because few assets combine recurring cash flow, leverage, appreciation, and tax efficiency as effectively as multifamily real estate. The first advantage is predictable demand. People always need housing. Unlike luxury retail or discretionary entertainment, apartments satisfy a basic human necessity. Even during economic slowdowns, rental housing often remains more resilient than many other commercial property sectors. The second advantage is leverage. Banks are generally willing to finance apartment acquisitions because rental income provides relatively stable cash flow. This allows investors to control large assets while committing only a portion of the purchase price as equity. The third advantage is appreciation. As neighborhoods improve and rental demand grows, property values often increase significantly over decades. Unlike automobiles or machinery, well-located land generally appreciates rather than depreciates. Tax benefits further enhance returns. Buildings, improvements, equipment, and many interior components can be depreciated over time, reducing taxable income while the underlying property continues generating cash flow. Professional investors also use refinancing strategically. As a property's value increases, owners may refinance, extract equity, purchase additional buildings, and expand their portfolios without selling existing assets. This creates a powerful compounding effect. Institutional investors value apartment buildings for another reason: scale. A portfolio containing thousands of units spreads operational risk across multiple properties and markets. Professional management improves efficiency. Bulk purchasing reduces maintenance costs. Centralized leasing increases occupancy. Technology automates operations. Large owners often negotiate better financing, insurance, and supplier pricing than individual investors. Perhaps the greatest advantage is inflation protection. As wages and prices rise over time, rents frequently increase as well. Meanwhile, owners with long-term fixed-rate debt continue making the same mortgage payment while rental income gradually grows. This combination has made apartment buildings one of history's most effective long-term wealth-building assets. Successful investors don't simply buy buildings, they buy future cash flow. Owning an apartment building isn't about collecting rent once a month. It's about managing people, property, capital, and risk every single day. The apartments generate income. The land builds wealth. The financing creates leverage. The tax code rewards long-term ownership. And careful management transforms ordinary buildings into extraordinary financial assets. The wealthiest real estate investors understand a simple principle. They aren't buying concrete and bricks. They're buying decades of predictable cash flow backed by one of humanity's most essential needs: housing. Because in real estate, fortunes aren't built when you collect rent. They're built through disciplined ownership, patient capital, and time.